if you really look at active versus passive funds, passive fund, since these are actually created based on index strategies, and indices clearly have an advantage of very transparent portfolio creation process, which includes asset allocation, security selection. So these disclosures clearly come on a almost on a regular basis, on a daily basis, I would say. So that's clearly visibility of the portfolio, transparency about portfolio is one critical element. Two, if you really want to focus on aspects such as yield and HTM as a strategy. Yield is something which you could certainly track by looking at the portfolio construct, and given the horizon of investment that you are really looking at, you would get a fair sense of yield that one can really attract, subject to the inflows and outflows of the funds. But it's a good sort of a start. And the three, extremely important, is the expense structure itself, which is about 100 basis point between the active and passive. And on a debt fund, it certainly means a lot. So that's a fair question, and probably I'll break it into two aspects. So clearly, as on the index side as well, the strategies that we speak about that exist on the active side can certainly be replicated, and to some extent, from a security selection, or from that, for that matter, the kind of assets that you're picking up in the portfolios itself, that certainly can be or is being replicated. But it can be, certainly there is scope for creating more and more security classes there. So just to take an example, today we even if we talk about target maturity, there is a GSEC, state loan, and AAA PSU portfolio, and that's what you tend to hold even on the active product categories. Themes such as say banking and PSU is one theme that we speak about, or for that matter, medium duration, long duration categories that really exist on the active side. I think as the appetite for investor really comes in, that's one. Two, the market making aspect of bond market really comes in place, and there becomes a robust mechanism. I think some of these funds as well can be created as we go along in our ecosystem. I would try and answer that. Maybe it could be a bit, I would say, subjective sort of question, response, in a sense that since investors actually look at investment purely from the perspective of, one, clearly financial goals that they have. That's one. Two, there is risk appetite that is really attached and could be different for each of the investors. And three, clearly the time horizon one is really looking at. So depending on each of this, one really tend to take their decision on allocation. And just to give an example, if you are a risk averse investor and you would want to achieve a specific financial goal over a period of next 5 years, and you would want to be maybe want to have a very strong probability of creating that wealth, you would rather stick to a fixed income products which grows at a defined rate and gives you that kind of wealth creation, or setting aside that sort of an amount for you as part of your financial goal. So I think that is what really ultimately decide what asset allocation one should really be working with and comfortable with.